Ladies and gentlemen, how we doing? Welcome back to another FOMC day. It's going to be interesting, huh? So we are going to get the interest rate decision here in about 30 minutes. The market is really unchanged. Today we have not seen anything too crazy. For those of you guys in the LTMP group, we did have a couple of potential, really solid potential post-earnings candidates for today. But like I was saying in the pre-market plan, there's not going to be anything to do today. If you guys are trying to trade FOMC day, seek help, call the Gamblers Hotline. This is not a high probability day to be taking a lot of action or to be being very active in the market here. But we could obviously see some things heat up towards the end of the day here. It has the potential to be pretty volatile, but I think everybody kind of has a good understanding of what's going to happen at this meeting. We're going to go through a little bit of my expectations here of what's going to be said, the different questions that Powell is going to be asked, and which ones we want to pay attention to the closest. So, ladies and gentlemen, it is that time of day again. Say good afternoon today to somebody in the live chat. If you guys would like to say good afternoon to me, love to receive some good afternoons over here. If you guys are new to the group, new to the stream, let me know. Love to welcome you guys in here. And as always, ladies and gentlemen, make sure you guys are hitting that like button on the way in. It costs you absolutely nothing to do it, but it helps me out a whole lot, spreading these streams out to as many people who actually want to learn, and especially on an FOMC day. Remember, guys, we have that 200 like goal on the stream here. If you guys can hit that, that'd be awesome. So again, make sure you guys are hitting that like on the way in. Let's go through a couple of these individual names here before we start getting into some things. So Palantir, again, really nice period of consolidation at the highs, going into earnings on Monday. Yeah, on Monday, I believe. So we'll see what happens with this one. I mean, this has just been an absolute monster. This is not a name that you want to buy up at these elevated levels, but it's absolutely not one that you want to go out and short. SoFi is another one that I want to talk about quickly with you guys here. I can't stress this enough. Like, when I come out and tell you guys that it is not the time to buy something, I'm not saying it for no reason. We've been talking a lot about SoFi here and about the times over the last really year where it made a lot of sense to buy this one. Now, the first one was obviously at 655, where I gave this one out to the Less Trades More Profits community. And then recently, one that we've been talking a lot about in the videos, in the streams, on Twitter, was the $13.60 weekly breakout. And again, SoFi is still trading at 21 to 22 here. Again, still, if I like something in the 13s, I'm not going to like it, or I'm going to like it a lot less at 20 to 21. And I don't really think it makes a whole lot of sense for me to say that 100% higher, you guys should be buying something that I was interested in 50% lower, if that makes sense. So, before we continue, let's do a little bit of a roll call here. Let's see. Oh, you guys are going crazy on the like button already. Thank you, guys. We have Miguel, Eddie, Rogue, Hush Puppy, BM, Striker, Yankee, Geister, Eddie, Garrett, Jonathan, Romeo, Kimberly. Good afternoon, ladies and gentlemen. So, couple more charts I just kind of want to go through with you guys just so that you guys can see them. Neo was actually looking like it wanted to get a nice period of consolidation and form a bullish setup. Now that we're invalidating down below the 10, having this sharp period to the downside, the next spot that you want to look for is right around this 200 exponential moving average at like $4.34. If it holds there, sure. We are going to look at the release of the Onvo. I think it's the L90. What is it, tomorrow? Coming up over the next few days. So that could be interesting. LI Auto sold off, I believe, pretty significantly off of theirs. Yeah, off of their release. So, again, Neo's had problems with these Onvo releases in the past. Hopefully they learned from their mistakes previously and are able to execute this time. What else do we want to take a look at? HIMS ripping back to the upside there. There we go. Earnings on Monday as well. That's going to be another interesting one. And like I was telling you guys before, this is another one that I was outlining for you guys that, like, I didn't think it made a whole lot of sense to be buying up in these levels here, mainly because I gave it to all of you at 30 to 31. It's the same situation there. Now, what I did say over the last few weeks, that if we got this break to the upside of about 53.20, I believe that happened on one of the public streams here, that's not the worst place to be buying or adding HIMS. And as you guys can see, we did see pretty significant move up in HIMS here from 53.20 all the way up back into the mid 60s. So again, when you guys are looking at these charts, these individual names, there is a time and a place to be interested in them. You can't just go willy-nilly saying, oh, it's up so much, let's just go buy it just because. There's always a time and a place to be either sitting on the sidelines, to be trimming these positions, and also potentially to be adding here. So let's see what else we got. OKLO Is that one, didn't I highlight this one for you guys like last week too? Kind of off this price? Or no, we looked at this in here where it was like, it's interesting, but this is not one that you would want to be interested in going into earnings. So what do we have? 25 minutes until we get the interest rate decision. So that'll be interesting. We don't get an SEP, Summary of Economic Projections, this time around. That next one will be in September. But those, again, are really only good for like the couple weeks after. They're not very relevant for the entire quarter. So the other thing that I think is going to be interesting today with Powell is this slight move up in inflation that we've seen. It's not really all that significant, but I think the main thing that a lot of people are going to be asking about is the preliminary GDP reading from quarter 2 today. GDP came in at 3% versus the expectation of 2.4%, but PDFP, which is what Powell was citing around the time that first quarter GDP was being released. Remember, GDP in the first quarter was negative. I think it got revised up a significant amount, but when it first came out, what Powell was saying was, private domestic final purchases, we're in a decent spot. We're really not looking at this declining GDP number as a sign of economic slowdown. It really just has to do with the elevated level of imports. Now that PDFP was kind of slipping a little lower here, showing a little bit less demand, it's going to be interesting to see if Powell cherry picks the data and says, oh no, we're just looking at headline GDP. It's back up to 3% and we're not going to cut any rates. Again, the Fed loves to say that they are not acting politically, but it does appear that they are, especially with some of the other FOMC meeting members being a little bit more in favor of a cut than they were in the previous months. We did see it was Bowman and Waller, I think, were the two that came out in June that said that if the data starts to look a little bit better, they would be open to a July cut. It is possible that when we get to this interest rate decision today, I don't think it's very likely, but you might see a descent if we end up seeing, which I think is likely, that the Fed doesn't cut rates. So that is something to look out for as well. ASON, why are you guys so jazzed about ASON? What's going on with this? Yeah, it's moving up. You technically shouldn't be in this one because it hit below day's low. And again, guys, like I was saying with FOMC, there's not really a whole lot to do. If you do decide to take any of these breaks to the upside, you got to be sizing them for zero. If you guys then took all of those warnings and decided, I'm not going to listen to what STV says, then I don't know what that'll help you. But let's see. Snow I really like. Snow looks pretty dirty. And I do... Ooh, it's moving. Yeah, we'll see. Again, this is the way that I'm viewing the market right now, and this is the way that I think everybody should be viewing the market. One, don't gamble on FOMC unless you want to just let everybody in the live chat know that you're a dum-dum. The second thing is that if we do end up seeing a positive reaction out of the market on FOMC, you guys do realize that it's just going to be set up city, and I'm going to go hand out another giant round of multi-100 and multi-1,000% trades to the LTMP group. But it needs to confirm for us. We have to confirm. It would need to confirm that we are going to be in a good spot depending on the tone of the Fed. William, what's up, man? So I hope you guys are ready. It's going to be fun. Remember, for those of you guys that still need to hop into LTMP, I seriously don't know how many more times you guys need to see me call out the most disgusting trades in the market. Last week, you saw over 6,200% on Kohl's, 3,600% on Krispy Kreme. The American Eagle trade was epic. Last week, or the previous week, was 600% Roblox. I mean, I just keep handing them out. You guys don't like making money? Gold's going to trend up over time. The administration has already outlined for everybody that they're going to run it hot. In general, we are going to see relatively higher levels of inflation that we have in years past. Gold is going to benefit from that. Same thing like Bitcoin, silver, all of them. So this FOMC meeting is not really going to decide anything on the medium to long-term prospects on gold. So, but let's see here. What else we got? It's been a slow week so far. There's really nothing, but that's what the less trades, more profits methodology is all about. It's like when we see these really great setups, like every single one of you in the live chat has the ability to go out and nail these multi-100 and multi-1000% trades. It's not hard. It's really simple. Once you guys go through the curriculum videos, you're going to be like, why was honestly the most common feedback that I do get is, I don't know why I wasn't doing this all along. And it's like, I know. I try to tell you guys. Let's see. Josh says got 520% on D-Nut last week. There you go, man. There you go. So yeah, I'll throw the link in the live chat here for you guys. Make sure you guys use code July. You get 50% off your first month. It's literally $1 a day. There you guys go. I love snow here. Really love snow. If it breaks during FOMC though, I won't be touching it. Just how that goes. We talked about this in the private stream this morning too. I was like the main reason why, like, somebody brought up the concept of discipline, and the way that you actually have long-term success in the market has literally nothing to do with discipline. It's so easy, stress-free. I know, Daily Taylor. I don't know why. I literally don't know why every single person in the market doesn't operate the way we do. It's the simplest yet most effective way to do it. We have all the results to back it up too. You guys saw it last week. But this is what we were talking, like the concept of discipline when it comes to the market, it's not, it's sort of relevant, but it really isn't, because let's say, for example here, it's just logic. That's all it is. Really, at the end of the day, it ends up being logic. So a hypothetical example, like if you knew for 100% certainty, 100% sure, you were 100% sure in a hypothetical scenario that you were going to make, I don't know, 100% on your account in a year, 500% on your account in a year, whatever crazy number it is, if you know the steps that it's going to take you to get there, you're like, okay, I have this set of steps, and I know hypothetically for certain this is what the results are going to be, then why would you ever do anything else? So then you can reel that back and say, okay, well, we have a really good understanding, not 100% obviously, but we have a really good understanding of what we're able to generate out of the market the way that we operate in it. So then why would we do any nonsense like YOLO, SPX, FOMC, or chasing stocks at the highs, or hyping up? Like, I just don't get it, you know? So that's why I said to you guys in the, or what's his name, in the group, when he was like, I'm going to go YOLO, FOMC, I was like, I will never understand that, because you guys have like the best system and the best way to operate in the market right in front of you. Every time. So what do we got here? 18 minutes to go until the interest rate decision. That's going to get fun. We've got, what else? Powell probably won't lower rates today. Hassett says the data is consistent with the Fed cutting rates. I mean, at certain points this year it was. I don't know if you can make that argument right now with NFP and the unemployment rate moving lower, and then growth being at those elevated levels, and then, or like coming in at 3% versus 2.4. It's like, I don't know. Funstrat's Tom Lee, probabilities favor stocks rising following the Fed decision. I do think that this meeting is going to be a little bit of a dud, because we just understand, like, everybody should kind of understand where the Fed is right now. They're like, we have to wait and see what's actually going to happen with these tariffs, and they're just like, they're almost acting like the boy who cried wolf, and just over and over saying, oh, but the next one's going to see the inflationary spike every single time we go through this round of data. So I don't know. We'll see. I think it'll be interesting to see if there's a descent when the Fed doesn't lower rates today. RSLV, isn't that the biotech that you guys were talking about to me this week? If this is RZLV, sorry. Oh, Resolve AI. Oh, we talked about this. I don't really like this. It's a decent looking chart, but like, I don't know anything about it. So, I mean, if you look at the weekly, it's probably all right. Yeah, weekly setup looks pretty good. You do have earnings coming up, though, which you got to be careful of always. Yeah, especially when they're projecting 4% growth. Like, if you can grow at 4% with interest rates as high as they are, there's no reason for the Fed to be cutting. So it is funny when Trump is like, come on and cut rates. Like, I bet the weekly looks good on this. Hasbro? Yeah, weekly on Hasbro looks really good. I'd actually throw an alert on that. You know what I actually really like? Who said this? Yeah, Fromito. You came in with a really dumb comment. Sorry. I always like to call it how it is. You're like, oh, I'm going to YOLO SPX for FOMC. Sorry. Stupid. But I really like this chart here too. You've redeemed yourself today, in my eyes. Chat, we have a weekly setup on weed stocks here. MSOS. I like it a lot, actually. So this is one you guys can have. This is a freebie. Those of you guys that are not in the LTMP group yet. I didn't mention this about it. If you don't hop in by September, prices are going up. If you hop in before September, you're going to get locked in at the lower rate. Also, here's the thing. I think we can hit the 200 like goal today, ladies and gentlemen. I think we can do it. We're already a quarter of the way there, and we haven't even started Powell yet. So keep smacking that like button on the way in. We have a 200 like goal for the stream. Again, just as a reminder for you guys, I do public live streams for you guys every single day at 10:30. Again, because I'm live for the LTMP group earlier. So make sure you guys have notifications turned on. We didn't do that stream today because the entirety of that stream was basically gonna be me coming on here and saying, "Hey guys, looks good. Wait for Powell." You know. So make sure you guys have notifications turned on. Let's see. Slackers on the like button? I don't know. I think we could hit 100 pretty quickly right here, and then we'll grind our way up to that 200 like goal. It is an FOMC day. So we might be able to get there pretty quick. That'd be fun. Let's see. Dissing you, Fermito, you deserved it. You guys, because here's the thing. If you guys come in and I don't say anything to you guys when you're like, oh, I'm going to YOLO FOMC, if I don't, crack the, reel you guys back in, you're just going to think that those are okay actions to take in the market, and they just aren't. If you want to have long-term success in the market, here's what you need to focus on. Only doing what is proven to work over time and aiming to do zero of what is proven not to work. Just very broadly, if you can focus on that. Again, guys, making money in the market is the byproduct of good decision making. Big C, appreciate you, buddy. Nvidia and AMD prices are neck and neck. Yeah, but the valuations aren't. Where is AMD right now? Where's my baby? Yeah, I love MSOS. Fermito, good call, buddy. Those are actually some of my favorite charts. Where's ACB? Are we gonna do this again? Oh, guys, I don't know. I mean, you guys, here's what the funniest thing is about what we do in the group. It's I tell you guys every day, it's I'm just gonna come out every single week and show you guys some of the most disgusting trades in the market. And then you guys are like, oh, I don't know. And then last week, it's oh, here's a 6,000 percenter, here's a 3,600 percenter, here's life-changing gains on AE up. I'm telling you guys right now, if that MSOS fires, oh, it's over. It's gonna be one of the most disgusting things you've ever seen. Just saying, I'm warning you. But again, a lot of these that we talk about in the streams, don't touch them because you have to go through the learning curriculum videos to understand how to execute them. Because at the end of the day, one of the most important things is understanding the exact reasons when and why you're entering, how you're going to manage the trade when you're in it, and where and why you're going to exit. Those are the most, I would almost say they're almost the most important things about the market. MSOS is a post-earnings trade. MSOS is a weed ETF. Where's Tilray? Where are those? They don't look good. I don't know why MSOS looks that good. I mean, what else is there? CGC. That doesn't look great. Why is MSOS looking so good? It's the weekly chart on it. You're here to learn, but you did buy a couple calls on Tesla. I don't know, guys. You want to gamble? Call the Gamblers Hotline. Sometimes I just don't understand what you guys do. Having patience and sitting on the sidelines is a part of the market. Your performance in the market is directly correlated with your ability to sit there and do nothing sometimes. If you don't learn it today, you're going to learn it at some point. So maybe it works, maybe it doesn't. But thinking about it like this, Jesse, even if you were to make, 1,000% on those Tesla calls today, it's not a repeatable approach to the market, and it's going to give you a false sense of your ability in the market. That's what it's going to do. Trump saying we should lower rates. All right, we've got about 11 minutes to go here, guys. I still don't think we're going to get anything crazy in terms of this FOMC meeting, all because of the Fed. High interest rates hurting people trying to buy houses. Yeah, interest rates aren't coming down. Tesla could easily melt up or crash down and nobody knows. Right. It's like we were talking about with like when some people were asking me about price targets this morning and I said like thinking about them or to like re-add things, it's almost a waste of time because you're asking what you're actually asking for. And this is why like people that give out these like random price targets for like when to buy and things like that really just have a really bad understanding of the market and the different factors that influence it and the ones that you need to account for. Here's what I mean. If you're gonna ask, like, let's say, and the question was on SoFi because somebody was, they trimmed their SoFi leaps after the 1360 weekly breakout that I gave out to everybody. Great move there. Those were like 350%. So again, I could just keep showing you guys these all day long. But they were like, oh, what would be a good price on a pullback to buy SoFi? And to me, I'm thinking about that in terms of like, let's say that SoFi hits an arbitrary level here of 8 months from now. Let's just say. Okay, what is then going to be happening with the company at that time? What's going to be happening with macro? Where are we in the cycle? Is there a new war breaking out? Is there new tariff nonsense happening? Like there's too many. So like if I say that as a level, it's like, well, there's so many other factors that you would then have to account for. So what you would actually want to do is just wait until the chart is actually telling you that it's okay to hop back in. And then also looking at the broad picture of the market at that time and saying, is this a good, what do you call it? A good, it's on the tip of my tongue, environment to be adding things in. That's a smarter way to do things than just having like an arbitrary price target on something. So again, it's like, I think a little differently about the market, which is one of the main reasons why my performance is the way it is. So, let's see here. Ooh, we're getting close. I mean, I think we're going to hit that 200 like goal, guys. If you guys are enjoying the stream, it's FOMC day. Make sure you guys are hitting that like button on the way in. Help spread these streams out. We're going to have some fun. 8 minutes to go until market open. Swiss roll 44% profit on ASON. Nice. Probably smart to be trimming before FOMC. I really like this snow chart. I really like it. But just because I really like a chart, guys, it's like what we just talked about. You have to think about the environment that we are in. And right now, as of today, the environment is be very careful because Powell is going to open his mouth. So we'll see what ends up happening. Workday, I think we talked about. Yeah, I do really like this setup here. I'm going to throw an alert on this one, even though it's just under the 200. This is one that we talked about on the watch list this week in the group. Oh, market open? Oh, dude, I'm so used to streaming for you guys in the morning. No, 7 minutes now to go until Powell. Sorry. Fubo. That looks interesting. I really do like that MSOS chart though, the weekly. The weekly chart on MSOS it's calling my name. And I think we're going to have some fun with it. You guys excited for Powell? You guys excited? It's going to be fun. It's going to be fun. It's always a good time with Powell. It's always a good time. You have markets kind of jumping around. You guys see this? Do you guys want... So I'm going to talk about this in a YouTube video. So be on the lookout. That YouTube video will probably be tomorrow, but I'll give you guys a little bit of a teaser of what's happening right now. Those of you guys that have been paying attention, remember, pay attention or pay a premium. It goes with everything. It goes with everything. Look at the dollar. The dollar is starting to shift its downtrend. What have we been talking about with the dollar over the last year? Or not year. Well, yes, 2025. Year to date. Foreign money has been flying out of U.S. markets in the first and second quarter. Some of the second quarter. And those foreign markets have been outperforming U.S. markets because of all that new additional demand coming in. Now, what I said before was like, well, if you see the markets break all-time highs, that's probably going to mark a low in the dollar. Like if you look at this right here, where is this? Tuesday, July 1st. When did we hit all-time highs on the SPY? It was pretty close, probably. When did we hit all-time highs? It was right here. Yeah, it's pretty close. Pretty close to the bottom in the dollar. What the market breaking all-time highs actually means in the context of the dollar and the flow of money globally is that foreign money is probably going to start cycling back in because they're realizing that there's no alternative. Then when you look at USD JPY, remember when I predicted the carry trade blow up for you guys last year? They're doing it again. Not in the sense that it's going to blow up, but in the sense that they are going to be shorting the yen effectively by taking out loans in Japanese yen, converting it into dollars, potentially showing a stronger demand for dollars, and then adding that bid to the equity market. And a lot of the time, or last time they did this in a big way, they were just bidding up the NASDAQ. They should be buying treasuries, but they're doing it to the NASDAQ, which is crazy. It's very, very, very risky. But again, that's just how it goes sometimes. So the chart of USD JPY right now looks like it wants to launch. That happens, the yen's going to devalue versus the dollar, and that's probably going to coincide with a lot of that carry coming back into the US. So just be aware of that. There's a lot of different factors out there right now. Again, that's like not relevant really to like our short-term trading. I could teach a 4-year-old to do that stuff. It's very simple. Day, what's up, man? How you doing? ASON, I know you guys keep talking about ASON, man. Looks good. I'm not in it. Again, we're going into FOMC weeks. I really don't want to be touching all that much. But, I mean, after today, I think we're going to be smooth sailing. They are 100% going to cut. Interesting, because GDP is at 4% and inflation ticked up a tiny little bit with the Fed that's already worried about those things happening, and you think that dictates a cut? I don't know, man. I mean, I can say that it would have made sense for them to cut at least once this year, but like understanding the frame that the Fed is actually looking through, the lens that they're looking through right now does not actually suggest that they want to cut. Of the banks, like in general here, I can take a look. I mean, they look good. I typically don't trade the banks because they don't burst very well. I mean, sometimes they do. Like you can get some decent moves here, like on Citi. You just got to trade them with a little bit more time, but they look good. They are extended, but they do look good. So let's see. Guys, we are 19 likes away from 100 on the stream. Thank you. Appreciate it. We're almost halfway there to the 200 like goal on the stream, guys. I love it. Thank you, guys. I appreciate it. So let's get ES back on here. We've got 2 minutes to go until the interest rate decision. I'm going to be breaking down all the headlines as they come through for everybody. So here we go. We're about to get into prime time, ladies and gentlemen. Here we go. Ulta's getting interesting. Is it now? Hold on. Yeah. Yeah, I like that, actually. It's extended as hell, but like, yeah, it looks good. I'll throw an alert on that. MSOS just looks fun, man. That weekly chart is calling my name. So yeah, once you guys hop into the group and you go through the learning curriculum videos, which is not going to take you very long, you're going to look through it and be like, wait, it's that simple? That's how you're nailing all these multi-hundred and multi-thousand percenters all the time? And I'm like, yes. Why don't pay attention or pay a premium? It's so simple. Netflix didn't recover from the earnings crash? No? Why would you expect it to? It's just bleeding out here. Where's my baby? AMD? All right, 40 seconds, ladies and gentlemen. Here we go. Oh, and we're 8 likes away from 100. There we go. We got a lot of slackers on the like button today. Interesting. Really does. You talking about MSOS? That looks filthy. MSOS looks nasty. So, all right, guys. Yeah, and then we're going to have, after this comes out, we're going to have about 30 minutes until the presser with Jerome Powell, which is going to be very fun. That's when things get fun on the streams here. Like, this is like strictly business time. But once they start talking, oh, it gets fun. 7, 6, 5, 4. Here we go. Here we go. And it's a dud. It's a dud so far. Let's see. Let the AIs work. Rates unchanged. Bowman, they dissented. Oh, interesting. We did see a dissent. Bowman and Waller dissented in favor of a cut. Let's see. No notable wordsmithing. Yeah, this is a dud so far. They'll cut in October. I think they'll cut in September. You already have 2 FOMC members dissenting. Remember how we talked about this just like 15 minutes ago? That it's possible that we see a dissent off of no cut, and it'll be interesting to see what the market's reaction is. There you go. So we had Waller and Bowman dissenting. So the FOMC voted 9-2 for the Fed funds rate action. So over the next month, one of the most important things that we're going to need to pay attention to, ladies and gentlemen, is not necessarily what Jerome Powell is saying, but what the other FOMC members are talking about. We saw Bowman and Waller over the last, let's say, month-ish. Yeah, friction is building, correct. Over really the last month, saying that they were potentially going to be in favor of a cut if the data started to get a little bit better. Now, the other interesting part of this is that the data didn't actually get better or more in favor of a cut. But you also have to think about Donald Trump is looking to select the next FOMC chairman or woman. So having these 2 individuals dissenting in favor of a cut, obviously there is that potential for them to be playing politics a little and saying, hey, I'm willing to do what you want. Pick me, you know? So that is another factor. But it is interesting that we saw that dissent. The market, again, like I kind of expected before, was not really going to do a whole lot. It is possible that we see somewhat more of a reaction during the presser. Fed economic growth moderated in the first half of the year. Uncertainty about economic outlook remains elevated. Obviously, that's in relation to trade policy. Let's see here. Fed removes, yeah, that's not, okay, so that's just interesting. I don't really agree with that. But Fed removes language saying uncertainty has diminished. Let me actually go find where they said that last time, because that was a pretty bullish statement last time they said that. Yeah, so although this is important, although swings in net exports continue to affect versus have affected the data, recent indicators suggest that growth of economic activity moderated in the first half of the year versus what they said last time has continued to expand at a solid pace. This is interesting. So what they're effectively saying is that growth is slowing down. The unemployment rate remains low and labor market conditions remain solid. Inflation remains somewhat elevated. This is where it gets important. The committee seeks to achieve maximum employment and inflation at the rate of 2% over the longer run. Great, I guess we're just still lying. Uncertainty about the economic outlook remains elevated, is what it says this time. But they remove has diminished, and then it went but remains elevated. So that's interesting. That is very interesting. So they're saying growth in the first half of the year is slowing down, and the unemployment rate is at an interesting area for them. I think they basically said unemployment rate remains low and labor market conditions remain solid. Inflation remains somewhat elevated. So again, they are still leaning into this inflation narrative. And here's what I want to look at too. What are the rate cut expectations for September right now? About 60%. What were they yesterday? 63.3. Interesting. So rate cut expectations actually went down from yesterday into today after the interest rate decision from today. So here's what happens next. We are going to be getting the press conference with Jerome Powell in about 25 minutes. Very much of a nothing burger FOMC so far, like we expected. Again, it could always heat up. We could always see some more craziness here. But at the end of the day, everything is kind of happening the exact way that we thought it to. Or we thought it was going to. Because think about it. Like, if the Fed is looking at the data and we know how they're looking at the data, and then we see more data come out, we're like, oh, we know how they're going to react to it. Oh, we saw inflation tick up a little bit. NFP, even though it's a survey, showed the unemployment rate moving down. Private payrolls were way low. which was not great. So that could start to have an effect on the unemployment rate and non-farm payroll data in the near future. And then growth came out today pretty significantly above what the market was expecting. But we also saw growth moderating, like they said in, growth of economic activity moderated in the first half of the year. So we don't have that stagflation narrative that everybody was talking about. You don't have elevated unemployment, really high levels of inflation and slow growth. So the market is going to view this, I think, as kind of a neutral FOMC right now, if anything, which is why you're seeing that reaction on the charts, because nothing's really changed. So let's see. Woo, guys, we are halfway there to 200 likes on the stream. Thank you. I appreciate it. We have about 75 of you, 75, 80 of you guys right now in the stream that haven't hit the like button yet. Slackers. Bunch of slackers. But let's see. So USD JPY is not moving. I want to see how the dollar reacted to this. Nothing. What are yields doing? What did they do off of it? I would assume almost nothing. Yeah, nothing. Nothing really. They were already moving down a little. Where'd that ASON go that you guys are talking about? Looks okay. But I also think that, I don't know, as we get into the August 1st deadline there for these new trade deals, I don't really think we're going to see anything crazy. If need be, they'll extend again, even though Trump has said that he won't. Because think about it like this. A lot of people were pretty worried about these new tariffs getting sent out a couple of weeks ago, while also coinciding with the deadline being moved. And the very, very logical way to look at that, guys, is, and this is why we were still able to continue to remain bullish and execute on the setups that you guys all saw, the multi-thousand percenters, the multi-hundred percenters that I was giving out to the LTMP group, was that if Trump really wanted to have those levels of tariffs on those countries, he wouldn't have moved the deadline. It's very simple. MSO has redeemed you completely. I mean, I don't want to say that, Fromito. If you keep continuing to like YOLO stuff, I'm going to continue to yell at you until you lose enough times doing it, and then you understand, oh, I'm just going to do like the thing that STV does and then crush it, you know? Like, I don't know, guys. I showed you guys the gains. I mean, I'm up over 100% in the last month, like 200-something% in the last 3 months. It's like, this is the best way to operate in the market. I've shown you guys the time. I'm going to, like, again, over the next week or so, I'm going to call my shot again, just like I did 2 weeks ago. There's going to be a time over the next few weeks, maybe a few times, where I come out on the streams with just one of the most epic return trades that you guys have seen. And I'm going to sit here like, I told you. I told you. Just like every other time in the past. So, again, just like last week too, like the reason why a lot of people are struggling to have success just generally in the market from a short-term trading perspective is that they don't prepare for weeks like last week, or really the last couple of months. When we see the market get hot like this, you have to be able to be ready to take advantage of them. And all the people in LTMP have just been murdering. Seeing the gains that you guys have made, man, over the last like few months here, and really since the time that I've been doing this with you guys, is literally unlike any other group of retail investors that I have ever seen. The shift that you guys have made is just unbelievable. And it's not that difficult. It really isn't. So let's see. I can throw the link in the live chat for you guys here too. But for those of you guys that are interested in hopping in, make sure you use code July, because that'll give you 50% off your first month, and it comes out to $1 a day. $1 a day to come learn this stuff, get skills that nobody can ever take away from you. Uh-oh. But then again, I mean, at this point, you guys have had enough of an opportunity to hop in there with us. Prices are going to be going up significantly in September. So for those of you guys that hop in before, awesome. You're going to get locked in at the lower rate. If you hop in after, sorry, you're going to have to pay a higher price. Yields aren't really doing much. I don't think we're seeing anything else crazy coming through the feed. I can take a look and see. I don't think so. Copper futures dropped 16%. Oh, that's why? ERJ getting hit. Oh, it's Brazil. White House, 6 minutes ago, White House says Trump signed an executive order implementing an additional 40% tariff on Brazil. Oofed. Oh, this was it too. Trump proclamation imposes universal 50% tariffs on imports of semi-finished copper products and copper-intensive derivative products effective August 1st. Is FCX American? I think they are, aren't they? They should be popping on that if it's... No, it's not. They're not. Which I thought they were American. Oh, South America. North America, South America. Yeah, that's why. Indonesia. They're not just American. That's why. Yeah, very muted reaction out of FOMC. So this is going to be a good learning lesson for all of you to just listen to me and not gamble on FOMC. I don't know what else to tell you. Don't do that. Don't be gambling. All right? Cool. Glad we're on the same page. Let me get this FOMC link up here. Let's say, here we go. You guys can't hear that yet, right? You should be fine. I think we're good. Yeah, I'll turn it on when it's ready to go. Neo 456 today? Yeah, I told you guys. I mean, it was either going to continue setting up and chopping in the range, or it was going to start shark fitting. The next level that you probably should look for on Neo is around 435, the 200 EMA. If it can't hold there and the release of the Onvo L90 does not go as planned, it'll probably drop back down below 4. That's how it works. Dude, I swear to God, the Neo people are really, like, culty. They're echo chambery. Like, I'll keep talking about it because I own it, and I own it for a specific reason, but, like, sorry, I'm not going to feed into your nonsense about, like, how it's guaranteed to have success. It's not. They either execute on their plans and their goals, or they don't, and I cut it. It's very simple. It's like an option. Like, I only own like 4,000 shares at like 455. It's not a big position. So, I am a very big fan of this weekly chart, though. You give me something on MSOS, I mean, this could be really fun. Like, really fun. Yeah, ready. Pay attention or pay a premium. Are we going to do it again? I actually might make a Instagram or TikTok video about this. That's a fun looking setup. I wonder if there's any regulation coming in the pipeline. There might be. I don't know. I'll look at that. So you guys are crushing the like button today. Thank you guys. Remember, I do public live streams for you guys every day at 10:30 a.m. Eastern time. We didn't do it today just because it's FOMC day, so I wanted to come on here instead. And then Fridays are on at 9:15 because that's the big public live day. So make sure you guys have notifications turned on for the channel if you want to come back and watch them. Kind of like apes. Yeah, they just don't listen. No matter how many times you show them that there's, and this is like some of you guys too, it's like no matter how many times that like I show you that there's like this is the proper way to operate in the market, some of you guys are just still gonna go gamble and do nonsense, which is really why the group exists in the first place. It's to actually give the people the skills that they need to have long-term success and be self-sufficient. One of the best things is on like the few cases that like, or the few days that like I'm not there, like seeing you guys identify the setups and being able to execute them yourselves is literally what it's all about. Am I still holding Neo? Yeah, why wouldn't I be? Has the thesis changed on it? Have they really shown us whether or not they're going to be able to execute and hit some goals by the end of the year, the kind of going into the middle of the next year yet? No. Again, when I own something, it's usually all thesis driven. The entry's based on the chart. I think the only thing that I've given out that's red right now is Novo. That's it. That's the only one. I mean, I gave you guys Palantir in the teens, SoFi at 655, Hood in the teens, Philip Morris at 95. There's more. There's a lot more. Those are just the big ones that come to mind. Trump says Nancy Pelosi should be investigated for insider trading. No. How could he? No. Not Nancy. Not our NVIDIA queen. You got in on too early on TJX? No? No, I mean, it broke that level that we were looking for. This, sometimes though, Garrett, sometimes they just take a couple of tries at them. Like HD, think about HD like this. Like, we still made money on it. But like the actual move on HD might come over the next like week or so. The problem now is that you're going to get closer to earnings. Like, this still looks good. I mean, if this thing broke back to the upside here, you still might get a good move. You know? Trading Marvel. Is it Marvel or MU that's starting to set up? No, I wouldn't. Guys, you sell gap ups. You don't buy them. That's another famous STV phrase that loves the strike. What else? MU though is starting to set up here. We might get something on this. All right, 15 minutes until we're gonna hear from our Lord and Savior Jerome Powell. He's like our Taylor Swift, isn't he? And like Donald Trump is like who? Calling out a single member of Congress for insider trading is hilarious, especially since she's even the most prolific at it. I mean, it's just like how she does it. Marvel up 10% today? Yes, so? So? You know? So what? Like, who cares? It could be up 1,000%. I don't care. Garrett, no problem. Like think about it. Like, it's up 10%, 8%. So what? Are you implying that because like this is a lot of the thought process that like you got to get away from? It's like, oh, because it's up 8% today, people are assuming that it's going to go up 8% again. Why would it do that? You know? It's just guys got to think a little differently in the market, just a little differently, you know? John lost all his discipline. It's not discipline, man. It's not discipline. It's understanding the strategy and the system and what your goal is in the market. It's not discipline. All of those mistakes come from a lack of understanding. Let's see. Jackson, welcome to the group, my man. Yeah, first step, again, for all of you guys that are hopping in there. I send all of you guys and direct you to the Start Here message in the Start Here area. That's going to kind of give you an idea of where to start. But first things first, go through the learning curriculum videos. If you have never traded options before, watch the options video in the Day Trading Mastery course. I don't think it really has anything to do with day trading. It goes through like how options are priced, how they move, and things like that. Then get right into Swing Kings. That is like 99% of what I do in the market. You get two nasty strategies in there. Post earnings and then the bread and butter one. Finding stocks that are about to explode before they do. But Striker, does that make sense? It's like when I'm talking about Marvel, it's like so what? Like why would the stock gapping up like this entice me to then buy it? You know, like you had some interesting setups in here, but like I probably wouldn't have traded this one. Like you guys see me call out stocks that are about to explode before they do all the time. And then they follow through and I'm like, yeah, don't touch it now. We've already nailed it, you know? Because like, where's the risk? Like you could maybe throw a stop at day low on Marvel, but then you have this gap here that's going to freak me out, you know? Oh my God. Guys, we might hit the 200 like goal on the stream. You guys are getting a lot closer to ankles. The ankle threshold is going to be 1,000 likes on the stream. I think by the end of the year, we'll be able to do it. Coinbase options are so expensive. Well, that might be because you're covering earnings, but Coinbase's chart does not look good right now. This is not a good chart. Yeah, it's because earnings are tomorrow. I'm not sure why you're looking at either this chart or trading Coinbase's options right now. You know? Why, Garrett, why are you doing that? I'm going to do another scan for all of us in LTMP tonight. Or this afternoon, probably. Maybe tonight. I don't know. We'll see. But I think once we get through today and just kind of get through some of this Powell craziness, smooth sailing. Nate, I don't think there's really any difference, especially on these streams. Just seen for tomorrow's earnings. Well, here's the thing, though. Once they report their earnings, you're going to see those premiums drop significantly due to implied volatility crush. If it will qualify? Yeah, it might. It might. That would be a fun one. We had a lot of potential good ones today, just you never saw the break of the level that we needed. So, again, I've done nothing today. Do I like a firm or are earnings too close? If you have to ask, probably, but let's look. Oh, no, that's okay. That's okay. You got a little bit of noise in this chart here, too, but, like, the weekly, I bet, looks great. It looks okay. But, like, the Affirm chart here doesn't look bad. If it flatlined for a few more days, sure. You could maybe go through for the monthlies for August and just play a quick burst, like a little pre-earnings run up there, but I don't know. It's not like a perfect setup, so I probably wouldn't screw around with it all that much. Remember, guys, I'm looking for perfect, like A+, high quality. That's how I'm able to give everybody these giant trades all the time. But yeah, there's not really a whole lot else that we have going on right now. Let's see. Did you guys see this today? Breaking. New study suggests a potentially hostile interstellar alien spacecraft measuring nearly 7 miles long could be on a trajectory toward Earth. If in the US we were allowed to bet on Polymarket or something, I would bet the under. Have you guys seen the guy that's just taking he just takes the nothing ever happens bet every time? I love that. That's awesome. I love the nothing ever happens. Because nothing ever does. Unless sometimes it does, though. Every once in a while you get something crazy. Home builders. I mean, let me look. Len. What else we have? Len. Ooh. I like that. I like that chart. That could be very fun. You call cap on that? Well, for those of you guys not in the US, it might be on Polymarket. Wait, was that Polymarket? Yeah, it was Polymarket. That was the tweet. So maybe it's on Polymarket right now. I'm not encouraging gambling, but oh, TOL does it look like this? It looks okay. I like Len better. I mean, this is above the 200, so Len would have some more meat on the bone there, though. Yeah, welcome to all you guys hopping into the group. You guys are making the right choice. Again, it's I show you this time and time again. Don't miss your chance before the prices go up in September. This is not something that you want to miss. I mean, if you guys have been watching the videos too, I mean, you guys have seen the gains and on Twitter and on Instagram just how ridiculous this stuff actually is. We'll see. All right, we have 8 minutes to go until Powell. Guys, we might hit 100 or 200 likes on the stream. We might do it. We might do it. We are about 70 away. But yeah, that MSOS chart weekly looks filthy. I like that a lot. I think I'm going to make a video about that. Like a TikTok, Instagram thing. Because I did call D-Nut and AEO and the Bitcoin move. So, for free before it happened on TikTok and Instagram. Those were fun. Those were fun. People are like, how do you, and I go, if you guys saw what I was doing, you're going to ask yourself how you didn't realize how simple the market could be and why you weren't doing this all along. Palantir is a great setup here, but I'm not going to trade it before earnings. The moves into the highs here are going to be very choppy, especially with how much this thing is overvalued. I'd be very, very careful with this one. See, like, I kind of wish I still owned it, but also not really. Like, I owned it at 15. I sold it at around 71. It was just getting too wildly overvalued, and I didn't really own enough of it to, like, I would have rather like rolled that into other things. So we'll see. I'm thinking about some new purchases. I don't know. It's tough when the market's at the highs for me to want to go out and buy some more stuff. And I do think a lot of them are going to be in the healthcare space over the next 2-3 years. You are seeing healthcare pretty deflated. You look at XLV over here. I mean, this thing is just hanging out at the lows. Like, this thing is, healthcare has not been doing well. Rates moving down would help healthcare. So be aware of that. The healthcare names could start getting interesting over the next year and a half, 10, 12 quarters. 5 minutes. We're going to hear from Powell. Here we go. Any guesses on what color tie he's going to be wearing, ladies and gentlemen? He was wearing a purple tie when Trump physically assaulted him. Yeah, very, very, very quiet so far. You're thinking purple? It might be purple. It could be. It could be purple. Did they bring my boat back yet? Oh, they did. Oh, cool. It's not actually my boat. That's a joke. Guys, that's a joke. It's not actually my boat. It's a nice boat, though. It's not even like a personal boat. It's like a touring yacht. I just like to say it's my boat because I stare at it the most out of probably everybody. All right, 4 minutes. Let's see what we got. Actually, I'll show you guys another one right now. I don't know what it looks like right now. I just want to look at it. This needs to tighten up again, but out of all of the names that I called out last week, like the Coles, the D-Nut, the the AEO, which is this. AEO is the only one that has potential for like a long-term move back to the upside. Like I can look at D-Nut here, but like, yeah, no, absolutely not. It was weird though with like AEO and D-Nut, like those entries, like it just started pumping in the after hours and I was just ditching both of those. Well, I think D-Nut I was fully out in the after hours. AEO I left a little bit until market open because I thought it was going to continue a little bit, and then I ended up ditching the rest of it in the 1250s. It was a shares trade. Both of those were shares trades for me, but those of you guys that took the options on it, that's how you made 3,000% on D-Nut and 6,000% on Coles. So you guys aren't going to see results like that anywhere else, especially with all the day trading garbage that's out there. I'm going to trade 1-to-1 risk to rewards. Okay, have fun. I'm going to trade 1 to 60s. 1 to 10s and nail them. We'll see who wins. Hint, hint, it's us. All right. 2-ish minutes to go here, ladies and gentlemen. Let's see. All right, we're going to wait for him. I'm going to have to mute myself and then... yeah, once we see Powell, I'll ask you guys if we can hear him, and then we should be good to go. We usually don't have any problems. But yeah, we're close, guys. We might hit that 200 like goal today. I think we could do it. Keep smacking that like button on the way in, guys. We've got about 2 minutes to go here. I'll throw that link for you, those of you guys that are interested in LTMP as well, in the live chat for you guys too. Again, it is pinned to the top if you miss it. But yeah, it's also the first link in the description as well. Use code July. It's literally $1 a day for you guys to hop in. You guys get everything. The full-length educational curriculums, both of them. Full watch list of stocks and cryptos that are about to explode before they do. The pre-market plans, the daily private live streams, the macro research reports, single stock research reports, direct access to me to answer all of your questions at pretty much all hours of the day. It really can't be beat. So welcome to all of you guys that are hopping in. We're going to get you guys up to speed. NVO, it's struggling. It is struggling. Let's see. All right, 30 seconds. There's no way Trump got a press pass. That would be so funny, though, if that happened. Oh, hold on. Hold up. Here he comes. Not yet. He's close. He's close. I'm waiting for that door to open to turn on the mic. Almost time. 2:30. Showtime, Powell. It's showtime. Let's see what you got for us today. I still don't see him. Come on. What's he in the bathroom or something? Oh, nope. Here he is. Here he is.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Despite elevated uncertainty, the economy is in a solid position. The unemployment rate remains low, and the labor market is at or near maximum employment. Inflation has been running somewhat above our 2% longer run objective. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged. We believe that the current stance of monetary policy leaves us well positioned to respond in a timely way to potential economic developments. I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that growth of economic activity has moderated. GDP rose at a 1.2% pace in the first half of this year, down from 2.5% last year. Although the increase in the second quarter was stronger at 3%, focusing on the first half of the year helps smooth through the volatility in the quarterly figures related to the unusual swings in net exports. The moderation in growth largely reflects a slowdown in consumer spending. In contrast, business investment in equipment and intangibles picked up from last year's pace. Activity in the housing sector remains weak. In the labor market, conditions have remained solid. Payroll job gains averaged 150,000 per month over the past 3 months. The unemployment rate at 4.1% remains low and has stayed in a narrow range over the past year. Wage growth has continued to moderate while still outpacing inflation. Overall, a wide set of indicators suggests that conditions in the labor market are broadly in balance and consistent with maximum employment. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.5% over the 12 months ending in June, and that, excluding the volatile food and energy categories, core PCE prices rose 2.7%. These readings are little changed from the beginning of the year, although the underlying composition of price changes has shifted. Services inflation has continued to ease, while increased tariffs are pushing up prices in some categories of goods. Near-term measures of inflation expectations have moved up on balance over the course of this year on news about tariffs, as reflected in both market-based and survey-based measures. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5%, and to continue reducing the size of our balance sheet. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. Changes to government policies continue to evolve, and their effects on the economy remain uncertain. Higher tariffs have begun to show through more clearly to prices of some goods, but their overall effects on economic activity and inflation remain to be seen. A reasonable base case is that the effects on inflation could be short-lived, reflecting a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed. Our obligation is to keep longer-term inflation's inflation expectations well anchored and to prevent a one-time increase in the price level from becoming an ongoing inflation problem. For the time being, we're well positioned to learn more about the likely course of the economy and the evolving balance of risks before adjusting our policy stance. We see our current policy stance as appropriate to guard against inflation risks. We're also attentive to risks on the employment side of our mandate. In coming months, we will receive a good amount of data that will help inform our assessment of the balance of risks and the appropriate setting of the federal funds rate. At this meeting, the committee continued its discussions as part of our 5-year review of our monetary policy framework. We focused on potential revisions to our statement on longer-run goals and monetary policy strategy, and are on track to wrap up any modifications by late summer. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Here we go.
Thanks, Chair Powell. There's a lot of lean in the markets, and not to mention out of the administration for a rate cut now in September. Is that expectation unrealistic at this point?
So, as you know, today we decided to leave our policy rate where it's been, where I would characterize as modestly restrictive. Inflation is running a bit above 2%, as I mentioned, even excluding tariff effects. The labor market's solid, historically low unemployment. Financial conditions are accommodative, and the economy is not performing as though restrictive policy were holding it back inappropriately. So it seems to me and to almost the whole committee that the economy is not performing as though restrictive policy is holding it back inappropriately, and modestly restrictive policy seems appropriate. All that said, there's also downside risk to the labor market. In coming months, we'll receive a good amount of data that will help inform our assessment of the balance of risks and the appropriate setting of the federal funds rate.
So just to follow up, by coming months, does that include the possibility you'll be getting essentially 2 rounds of jobs and inflation data between now and the September meeting? Is that potentially adequate to make a decision to lower rates at that point?
So you're right. We do have, this is an intermeeting period when we'll get 2 full rounds of employment and inflation data before the time of the September meeting. We have made no decisions about September. We don't do that in advance. We'll be taking that information into consideration and all the other information we get as we make our decision at the September meeting.
Steve.
Thank you, Mr. Chairman. You took out the word or the notion that uncertainty has diminished from this statement. Does that mean uncertainty has increased? And I'm just wondering, the administration has struck several deals with large trading partners where it seems like we now know what the rate is going to be. Does knowing that rate add to your certainty to change policy, or do you need to wait to see the economic effects?
So essentially, the statement in our statement about uncertainty reflects what's gone on since the last meeting. So at the time of the last meeting, uncertainty had moved down a little bit, but it was more or less even this time. So we took out, had diminished because it didn't diminish further. So there's not really much in that. And then your second question is, say again?
There have been several deals that have been struck, and now we seem to have an idea of what the tariff rates are going to be with some of our large trading partners. Does that not add to the kind of certainty you might need, or is it you're waiting for the economic effects to show themselves?
No, I think we're still, you're right, it's been a very dynamic time for these trade negotiations, and lots and lots of events in the intermeeting period, but we're still a ways away from seeing where things settle down. We are clearly getting more and more information, and I think at this point, people's estimates, our estimates, outside estimates of the likely effective level of tariffs is not moving around that much at this point. But at the same time, there are many uncertainties left to resolve. So yes, we are learning more and more. It doesn't feel like we're very close to the end of that process, and that's not for us to judge. But it feels like there's much more to come, as well, looking ahead.
Neil.
Hi, Mr. Chairman. Neil Jerome with Axios. This morning we got a GDP report in which final domestic private purchases decelerated, slowest pace since 22.
Listen up.
There was a weakness in the interest-sensitive sectors and residential investment, commercial structures. Are those not signs that monetary policy is a little too restrictive right now, given current economic conditions?
Great question.
The GDP and PDFP numbers came in pretty much right where we expected them to come in. You got to look at the whole picture. So certainly, as I mentioned in my opening remarks, economic activity data, GDP, private domestic final purchases, which we think is a narrower but better signal for future, for where the economy is going, has come down to a little better than 1%, 1.2%, I think, in the case of GDP for the first half, whereas it was 2.5% last year. So that has certainly come down. But if you look at the labor market, what you see is, by many statistics, the labor market is kind of still in balance. It's things like quits, job openings, and let alone the unemployment rate. They're all by many measures, very similar to where they were a year ago. So you do not see weakening in the labor market. You do see a slowing in job creation, but also a slowing in the supply of workers. So you've got a labor market that's in balance, albeit partially because both demand and supply for workers is coming down at the same pace, and that's why the unemployment rate has remained roughly stable, which is why I said we do see downside risk in the labor market. I mean, our two mandate variables, right, are inflation and maximum employment, stable prices and maximum employment, not so much growth. So the labor market looks solid. Inflation is above target, and even if you look through the tariff effects, we think it's still a bit above target, and that's why our stance is where it is. But as I mentioned, downside risks to the labor market are certainly apparent.
So on labor, given the fluid labor supply situation, is there a number for this jobs report we get on Friday that would look to you like equilibrium job growth?
The main number you have to look at now is the unemployment rate, because it's true that the demand for workers in the form of, let's call it, just say payroll jobs, that number has come down, but so has the break-even number, kind of in tandem. So, as long as that puts the labor market in balance, the fact that it's getting into balance due to declines in both supply and demand, though, I think it is suggestive of downside risk. So we of course, will be watching that carefully.
Thank you. Colby Smith with the New York Times. Two of your colleagues called for a quarter-point cut today, and I'm wondering what aspects of their argument were most compelling to you, and how you're weighing their views against those on the committee who, as of the June forecast, were in the camp of the Fed holding interest rates steady for the remainder of the year. And just in terms of the June SEP in particular, is that still the best representation of where the core of the committee is?
So on the dissents, what you want from everybody, and also from a dissenter, is a clear explanation of what your thinking is and what are the arguments you're making, and we had that today. So I think basically this was quite a good meeting all around the table, where people were thought carefully about this and put their positions out there. As I mentioned, the sort of the majority of the committee was of the view that inflation's a bit above target, maximum employment is at target. That calls for modestly restrictive, in my way of thinking, modestly restrictive stance of policy for now. But we had two dissenters who, I think, you want that clear thinking and expression of your thinking, and we certainly had that today, I think, all around the table. In terms of, you ask about the June SEP, I wouldn't. You're right. That's what it says, and that may well. I couldn't point to it 6 weeks later as expressing people's thought. You really can't do that. We don't run an SEP, and I don't like to substitute in my own estimate of what the SEP might be. We don't have one, so I'll just say that we haven't made any decisions about September. We'll be monitoring all the incoming data and asking ourselves whether the federal funds rate is in the right place.
And just on the point about policy being only modestly restrictive, does that mean that there's actually not much scope to reduce rates once the conditions for a cut are met, barring a significant weakening of the labor market?
So let me say, my own estimate is modestly restrictive, and there are a range of views of what the neutral rate is at this moment for our economy, and so others may say it's more restrictive or less restrictive even. We're going to be, at some point, when we return to moving toward a more neutral stance, we'll be making that judgment as we go. I don't think we have a preset course. It's not so mechanical as saying, we've derived with great confidence the neutral rate and that is our destination, because really we understand that no one actually knows what the neutral rate is. We know it by its works, and that will be how the way the economy reacts over time to, slightly looser policy.
Nick Timmeros, The Wall Street Journal. Chair Powell, my question is about what have you learned over the last few months about the inflation generating and price pass-through process? And just to drill down, the June CPI report showed evidence of tariff-induced goods inflation. Now, the tariff landscape is only starting to be settled with some of these more recent deals. Given the lags between when tariffs are announced and when they show up in goods prices, is 2 months a long enough horizon to evaluate the impact and be confident that tariffs aren't impacting the broader inflation process?
I think you have to think of this as still quite early days. And so I think what we're seeing now is substantial amounts of tariff revenue being collected on the order of $30 billion a month, which is substantially higher than before. And the evidence seems to be mostly not paid only to a small extent through exporters lowering their price, and companies or retailers, sort of people who are upstream, institutions that are upstream from the consumer, are paying most of this for now. It's starting to show up in consumer prices, as you know, in the June report. We expect to see more of that. And we know from surveys that companies feel that they have every intention of putting this through to the consumer, but the truth is they may not be able to in many cases. So I think we're just going to have to watch and learn empirically how much of this and over what period.
That's
of
my
time.
demand argument.
I think we've learned that the process will probably be slower than expected at the beginning, but we never expected it to be fast. We think we have a long way to go to really understand exactly how it will be. So that's how we're thinking of it right now.
So if I could follow up, is the reticence to look through core goods inflation being driven by the judgment that during the pandemic expectations proved more adaptive than anyone at the Fed expected? Is it being driven by uncertainty over how restrictive policy is?
You could argue we are a bit looking through goods inflation by not raising rates. We haven't reacted to new inflation, but I mean I wouldn't insist upon that. But I don't think I think the base case, as I said, a reasonable base case is that these are one-time price effects. Of course, in the end, there will not be. This will not turn out to be inflation, because we'll make sure that it's not. We will, through our tools, make sure that this does not move from being a one-time price increase to serious inflation. We want to do that efficiently, though, and that means we want to do it. If you move too soon, you wind up maybe not getting inflation all the way fixed, and you have to come back. That's inefficient. If you move too late, you might do unnecessary damage to the labor market. So there won't be, in the end, a big inflationary problem. What we're trying to do is accomplish that in a way that is efficient. But in the end, there should be no doubt that we will do what we need to do to keep inflation under control. Ideally, we do it efficiently.
Michael McKee from Bloomberg Television and Radio. The one big bill, leaving aside the adjectives, do you expect it to add stimulus to the economy in 2026? And would that be an argument for remaining on hold or cutting back on the number of rate cuts you would expect for next year?
So, of course, let me just ritual disclaimer that we don't express any judgments or anything like that on fiscal legislation or other legislation for that matter. But I would say when you think that, the biggest part of the bill was making permanent existing law on taxes, I don't think we see it as particularly stimulative. There should be some stimulative effect, but it shouldn't be significant over the next couple of years.
And to follow up, what do you, well, I don't want to put this in terms of you and the president, so let me ask it this way. Do you have concerns about the cost to the government of keeping rates elevated for longer in terms of interest rate charges?
Yeah, no, that's, we have a mandate, and that's maximum employment and price stability. And it is, it's not something we do to consider the cost to the government of our rate changes. We have to be able to look at the goal variables Congress has given us, use the tools they've given us to achieve those goals, and that's what we do. We don't consider the fiscal needs of the federal government. No advanced economy central bank does that, and it wouldn't be good for, if we did do that, it would be good neither for our credibility nor for the credibility of U.S. fiscal policy. So it's just not something we take into consideration.
Victoria.
Hi, Victoria Guida with Politico. When it comes to the renovations of the Federal Reserve's headquarters that the administration has been looking into, do you see their interest in that issue as being directly tied to the president's push to get you to lower interest rates?
Not for me to say. I will say we had a nice visit with the president. It was an honor to host him. It's not something that happens very often at the Federal Reserve to have the president come over, let alone to visit a building. But it was a good visit.
Are there any aspects of the project that they've raised that you see as making you reconsider any aspects of the project?
So, this project was hatched and conceived almost a decade ago now, and we went through the very long process of clearing it through historic preservation at the National Capital Planning Commission, and a lot of back and forth there. It was very constructive. We started out to do the work, and we're very well along on that work, and I was quite pleased to have the president say multiple times that what he really wanted to see was us getting this construction completed as soon as possible. That is our focus, and that's what we're going to do.
Andrew.
Thanks, Mr. Chairman. Andrew Ackerman with the Washington Post. What message do you take from the fact that inflation hit 2.1% last September and has bounced higher since? Why do you think financial conditions are restrictive and a neutral rate's below 4% when inflation has stopped falling for almost a year?
So inflation, when you talk about these 12-month inflation measures, you're always battling residual seasonality. So we'll have, for example, 2 months of high inflation sometimes early in the year, and then inflation turns lower, and a lot of that may just be an artifact. So that's why we look at the 12-month numbers. I think inflation is most of the way back to 2%. There are things like the catch-up inflation. So, for example, all the insurance costs that they're only now going through inflation, but they actually reflect inflationary pressures from 2-3 years ago. So that's got to go through. In addition, now we have 3 or 4 tenths of inflation in core inflation from tariffs. So, and we can't really separate that out. We're not going to have a separate kind of inflation that isn't the tariffs. We're always going to be dealing with all of inflation. But the composition, as I mentioned, has really changed. And if you go back to the last couple of years, it was all about services inflation, which was being very sticky. Now services inflation is coming down nicely. Goods inflation was well behaved before, and now goods inflation is going up. So the story has really changed. That's partially because of tariffs. It's also partially because we had restrictive policy in place, and we've seen that the result of that gradually work its way through the services economy.
Okay, the other thing I wanted to ask is, are you comfortable that BLS can continue performing their mission effectively if they take an 8% reduction in headcount and authorized spending as the administration has proposed?
I'm not going to comment on the administration's proposal. I do think, as I've said, I think that we're getting the data that we need to do our jobs, and I think it's really important that good data helps not just the Fed, it helps the government, but it also helps the private sector. People in the economy they use this data a lot too, so it's quite important for our economy and certainly for the Fed's work and other government agencies' work that we continue to get better at data. That's what we've been doing for 100 years. We've been getting better and better and better. It's very hard to accurately capture in real time the output of a $20+ trillion economy. And the United States has been a leader in that for 100 years, and we really need to continue that, in my view.
Edward.
Thank you, Mr. Chairman. Edward Lawrence from Fox Business. How concerned are you with the data that we're coming in, showing no significant upward trend in inflation over the past 6 months, that the wait-and-see approach for inflation is actually giving companies cover to raise prices?
How concerned am I?
That's a good point.
Say that again?
The wait-and-see approach is giving...
The wait-and-see approach, what do you mean by that?
For cutting rates. You're waiting to see if the tariffs will affect inflation. So it's a wait-and-see approach.
Well, so that's where policy's restrictive. When we start cutting, it'll go toward neutral.
Okay. This delay, though, where you're saying there's a one-time price increase for tariffs, which possibly could lead into bigger inflation or more inflation. Is that giving companies cover, though, to raise prices?
Well, what may be giving, it's not our policy stance, what may be giving some companies will certainly be taking advantage of the fact of the tariffs and all the discussion of how they're going to, if the companies will raise prices when and as they can. And you saw it famously in the first administration of President Trump during those tariffs. Washing machines were tariffed, but dryers weren't. But what do you know? The price of dryers went up too, just like washing machines. So companies will often just they'll cross the street in a group, if you know what I mean. That'll happen. We don't see a lot of that. I mean, what we see now is basically the very beginnings of whatever the effects turn out to be on goods inflation. And I'll say again, they may be less than people estimate or more than people estimate. They're not going to be zero. Consumers will pay some of this. Businesses will pay some of this. Retailers will pay some of this. But we're just going to have to see it through.
And just to follow, if I could, some additional tariffs have been in place since February, and things really haven't broken yet with the economy. So how do you justify to somebody who's looking for a house, who's facing a 7% mortgage and maybe can't afford those rates? How do you justify that?
Well, so the housing is a special case, right? We don't set mortgage rates at the Fed, right? We set an overnight rate, and the rates that go into mortgages are longer term rates, like Treasury rates. It might be 30-year rates, it might be shorter than that, but it's not the overnight Fed's rate. It's not that we don't have any effect. We do have an effect, but we're not the main effect. There are other things going on in the housing sector.
Oh, wait. Sorry. That whole argument with how do you justify people paying 7% mortgage rates? When the people think, and Trump thinks this too, sorry, we're going to get back to Powell in a second, but people think that the Fed is going to immediately cut rates and the 30-year mortgages are going to, the 30-year fixes are going to go from 7 to 4.5. That's not how this works. That's not how it works. Remember last year when I called the top in bonds? The day before the first rate cut, why was that? It has to do with market projections. If you have this this giant issue with the national debt, they're going to have to inflate our way out of it. And if you cut rates aggressively and run it hot, there's going to be even more inflation, even more dollar devaluation. And fixed income investors are going to require a higher rate of return in the fixed income market. And again, mortgage rates are tied to the Treasury market, like Powell just said, not the federal funds rate. So if Powell aggressively cuts rates, be careful what you wish for. Mortgage rates could go to 10%, okay? I hate when people say that. It just doesn't make any actual sense. The actual bad part about this is that he can't really leave rates where they are. if in terms of mortgages, but he can't cut aggressively either because that's not going to get mortgage rates down. So I don't know. It's a weird spot in the housing market, but it's not really anything that Powell can fix. All right, back to Powell.
Coming in, which before the next meeting, will it be dispositive of that? It's really hard to say. We don't make those decisions right now, so we'll have to see.
Well, I guess just in terms of inflation, though, for example, like some people would point to if it remains only in goods and it doesn't bleed over to services, then maybe that's evidence that the tariff effect is going to be a temporary one-time thing. Is that kind of thing affect your thinking, or do you just need to see the number come down closer to 2?
We'll look at everything. It's, as I mentioned, a pretty reasonable base case is that this will be a one-time price increase. And in the end, we'll make sure that that's the case. We're just trying to do that efficiently. And efficiently means getting the timing right so we don't, again, if we cut rates too soon, maybe we didn't finish the job with inflation. History is dotted with examples of that. If you cut too late, then maybe you're doing unnecessary damage to the labor market. So we're trying to get that timing right, and that's effectively what we're doing.
Claire.
Claire Jones, Financial Times. Just a question on the dollar. We've seen it decline quite heavily this year. I was wondering if there's been any discussion about that at the meetings and to what degree that might be complicating your attempts to get inflation back to target. Thank you.
So this goes back to the division of labor between the Fed and the Treasury, as you, I'm sure, know. And the Treasury only speaks to the dollar. It's not something that's been a topic of major discussion at all at the Fed. I won't say it doesn't come up. If the transcripts, when they come out in a few years, they'll probably reflect some mentions of the dollar, but it would never be a major focus.
And just to follow on, if I may, to Andrew's question, I think the amount of imputed data in CPI now is up to 35%. I mean, is there any discussion of that as well? Is there any consideration of looking at alternative measures, data scraping and so on, in order to just ensure you've got a good read on what's happening to prices in the U.S. economy? Thank you.
We're monitoring the situation. We do, of course, I mean, as you know, during the pandemic, we looked at a whole lot of new kinds of data. People are looking at big data sets that you can get from all sorts of places, and we do all of that. But we really need, the government data really is the gold standard in data, and we need it to be, to be good and be able to rely on it. And we're not going to be able to substitute for that, but if we'll have to make do with what we have, but I certainly hope that we get what we need.
Jay O'Brien.
Hi, Mr. Chairman. Jay O'Brien, ABC News. President Trump has obviously invoked your name a lot. He has personally pressured you. Are you concerned the way that conduct might impact the Fed's independence going forward?
I'll just say that, I think that having an independent central bank has been an institutional arrangement that has served the public well. And as long as it serves the public well, it should continue and be respected. If it didn't serve the public well, then it wouldn't be something that we should just automatically defend. But what it gives us, and other central banks, what it gives you is the ability to make these very challenging decisions that in ways that are focused on the data and the evolving outlook, the balance of risks, and all the things we talk about, and not political factors. And so governments all over the advanced economy world have chosen to put a little bit of distance between direct political control of those decisions and the decision makers. So if you were not to have that, there would be a great temptation, of course, to use interest rates to affect elections, for example. And that's something that we don't want to do. So I think that's pretty widely understood. Certainly it is in Congress. And I think it's very important. I'll just say that.
Maria Eloisa.
Afternoon, Chair Powell. Maria Luisa Capurro from Bloomberg News. You mentioned a slowdown in consumer spending, and I wanted to see if you could walk us through what was the discussion with the committee around that. We've seen delinquency rates rising for upper-income households. How do you see that evolving in the next few months, and how much of a vulnerability that is for the economy going forward?
Consumer spending had been very, very strong for the last couple of years, and had repeatedly, forecasters, not just us, had been forecasting it would slow down, and now maybe it finally has. So I would say, if you talk to credit card companies, for example, they will tell you that the consumer's in solid shape and that spending is at a healthy level. It's not growing rapidly, but it's at a healthy level, and delinquencies are not a problem. You mentioned high-end delinquencies. I don't know what to make of that. I read the same thing. But so generally, and if you look at the banks, and when the banks talk about in their earnings calls, the performance of credit has been good. So essentially, you have a consumer that's in good shape and is spending, not at a rapid rate, but it's true, and it was, again, right in line with what we expected, the GDP data that we got this week. And I think it's still a little bit difficult to interpret because you have these massive swings in net exports, which may also be affecting, some of that can affect consumer spending as well. Look, it's one of the data points that we pay most careful attention to, and there's no question that it's slowed. And we're watching it closely, but we also watch the labor market and the performance of inflation. Those are our two variables that we're assigned to maximize.
And just to follow up on what my colleagues were asking about this sense, Governor Waller said that the labor market is on edge, and he was pointing to weaknesses on the private sector. I was wondering, you've said that the main number to look at is the unemployment number overall, but what was the discussion about the state of the private jobs market?
So I'm not going to talk about any individual's, any individual's comments. I wouldn't do that. But look, I think what we know is that private sector job creation, certainly in the last report, we'll see on Friday, but had come down a bit. And if you take the QCEW adjustment seriously, which it may be even lower, maybe close to zero. But the unemployment rate was still low. So what that's telling you is that demand for workers is slowing, but so is the supply. So it's in balance, oddly enough. You've got a very low unemployment rate, and it's kind of been there for a year as job creation has moved down. But also we know that, because of immigration policy, really, the flow into our labor force is just a great deal slower. And those two things have slowed more or less in tandem. If you look at things like I mentioned, quits, look at wages. Wages are gradually cooling. Look at vacancies to unemployment. Those things have been pretty stable they haven't really moved a lot in a full year. So I think if you take the totality of the labor market data, you've got a solid labor market. But I think you have to see that there are downside risks. You don't see weakening in the labor market, but I think you've got downside risks in a world where unemployment's being held down because both demand and supply are declining. I think it's worth paying close attention to it, and we are.
Nancy.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. One more question on the lack of unanimity in today's decision, the two dissents. Was there talk during the meeting? I know you're not going to talk about exactly what individuals said, but in general, was there talk during the meeting of cutting rates, and what was the case against that at the meeting?
Sure. So, we have an economic go-around where people talk about the economy, and then that's yesterday, and then today we have a monetary policy go-around. All the way around the table, everyone gives their views. So the discussion around policy was, the majority view was still what it has been, which is that inflation's running above target, maximum employment is right at target. That means policy should be a little bit restrictive, somewhat restrictive, because we want inflation to move all the way back to its target. So that's where people have been and still are. Two of our members felt that the time had come to cut, and that they, for the reasons that they're going to express. I won't tell you the reasons they'll issue some kind of a thing in the next day or so. So, but that's the story, and I would say, you know, well argued, very thoughtfully argued all around the table, good arguments, and you know, it's a situation where unusual situation. The economy is in you know, good shape, but it's an unusual situation where you have risks to both your employment mandate and your inflation mandate. That's the nature of a supply shock, and it's probably not surprising that there would be differences and different perspectives on that, as well as different views of where the neutral rate is, so that different views of how tight policy is. So we have those. I will say what you hope is that people, you know, explain their positions very thoughtfully and clearly, and we absolutely had that today, all the way around the table. I would call it one of the better meetings I can recall from that standpoint.
And you've said you're waiting to be confident inflation is heading toward your 2% target before you start cutting rates. When you do get that confidence, would you be in favor of lowering rates right away?
It's not quite the way I would put it. You know, I said that's why we think policy should be restrictive, is because, you know, inflation is above target. When we have risks to both goals, one of them is farther away from goal than the other, and that's inflation. Maximum employment's at goal. So you have to, that means policy should be tight, because tight policy is what brings inflation down. If you came to the view that the risks to the two were more in balance, that would imply that policy shouldn't be restrictive. It should be more neutral, more you know, a neutral stance, and that would be somewhat lower than where we are now. No one knows exactly where that is. So that's the framework I think I'd be taking, and you know, we'll just have to see. We're going to be obviously looking at a lot of data in the next cycle. It is one of the cycles where we have 2 employment and 2 inflation reports, and we'll see where that takes us.
Jeff Cox.
Thank you, Mr. Chairman, for taking the question. Jeff Cox from CNBC.com. A metric that you like to cite a lot is the final sales to private domestic purchasers. That was down to a 1.2% gain in second quarter from 1.9% in Q1, suggesting that there's some softening in underlying demand. I just wondering if you look at that and you combine that with some of the housing numbers, the weakness that you acknowledged at the top of your remarks, that the housing market is in fact weak, and the inflation numbers from GDP today came down to 2.1% for headline, 2.5% for core. I'm wondering how much more movement you would need to see from these data points before you would be comfortable with cutting in, say, September.
It's going to be the total. Hard to answer that specifically. PDFP, I think, for the first half, private domestic final purchases, or final sales, as people call it, was 1.6 on the first half. GDP, I believe, was 1.2%. That's the whole half. You mentioned the quarters. So those are slower, but you know, GDP is bumpy quarter to quarter, half to half, and often gets revised, you know, after the fact. The labor market data we still think is, continue to think is the best data we have on the economy, and that shows a 4.1% unemployment rate. It shows wages, you know, still at a healthy level, but moving ever closer to what we would regard as long-run sustainable, consistent with longer-run productivity and 2% inflation. So the labor market is actually still quite solid. Inflation is above target, even ignoring tariffs. It's a little bit above target, and tariffs. So we're watching all of that, and again, trying to do the right thing in what is a challenging situation, because you're being pulled in 2 directions, and you have to decide which of those to go in. And actually, at some point, if they're sort of equally at risk, then you really want to be at a neutral policy stance, which we're not right now.
So it'd be safe to say that if the data kind of stays in line with where it is right now, that you wouldn't be comfortable with cutting in September?
I'm not going to say that. No, I just think we're going to need to see the data. And it can go in many different directions, the inflation data and the employment data. And we're going to make a judgment based on all of the data and based on that balance of risks analysis that I mentioned.
Thank you.
Greg, Rob, for the last question.
Thanks, Chair Powell. Greg Robb from MarketWatch. The Treasury Secretary has said recently that it would be confusing for the markets if you stayed on as a governor after your term as chair ends. And I was wondering if you had any update for us on a decision on that front.
Sorry, I do not have any update for you. Thanks very much, everyone.
All right, ladies and gentlemen, that was a nothing burger of a meeting. That was really big nothing burger of a meeting. The only reason why the market's selling off is that he was a little bit more, they're just still talking about the same stuff. Tariffs are going to be inflationary. It's coming next time. It's like, all right, guys, we'll see. I've been right all along this year, and the Fed has just continued to be on the other side of that. We are seeing some FOMC members starting to come out in support of a cut. So by the September meeting, which is when the next FOMC meeting is, that's most likely when we are going to see, or by then, we're going to see a couple of more FOMC members come out in support of a cut. So selling off a little bit here. This is really not big in the grand scheme of things. Now that we've gotten through Powell here, guys, now it's time to go have some fun again. So we're going to have a lot of post earnings tomorrow. We are going to have a lot of awesome setups coming up too. So for those of you guys that are hopping into the group, welcome. You guys are making the smart choice. I'll throw the link in here for you guys one last time before we end up wrapping things up. Again, make sure you guys use code July. You guys know what you get in there at this point. It's absolutely ridiculous, the results that we've seen from everybody in there. But yeah, so team, I'll see you guys tomorrow at 10:30. You guys publicly, everybody in the Discord, same business as usual. We're gonna be back live at 9:15. Have a great rest of your evening, guys. There really wasn't anything new in the FOMC meeting. Other than that, hit that like button on the way out. We're 45 likes away from 200. I don't know if we're gonna be able to get that, but we're close. But team, I will see you guys later. Peace.